Well, sticking to the mining sector, and Peter O'Connor from Shaw and Partners joins us live via Skype. Peter, welcome back to the program. Let's go and have a chat about iron ore. We've talked about it quite a lot in the program in the past. You warned about the potential for downside risk to emerge. Is that risk now starting to play out?
It has been playing out for some time, but it just hasn't been coming through in the iron ore price number until just very recently. So those red flags we've talked about, they continue to be there, whether it's port stockpiles in China or China's steel capacity utilisation or exports of iron ore from Brazil and Australia to China. But red flags continuing to come up, and we have seen the price finally start to soften over the last week or two. On the back of that, we're now in correction territory for both iron ore price and also for iron ore equities, so it's starting to filter through. There are some bulls hanging on to the view that iron ore price will stay high for longer, potentially many years, but it does feel like those red flags are seeing correction. And interestingly, the demand in China, which has been incredibly robust for over 6 months post their turnaround from the pandemic low, we're just starting to see now some stock build in steelmakers, both in products for construction but also for consumer goods, and that's starting to see a little bit softer demand. So we'll see that coming through in the PMI data, which comes out in China on Wednesday and Thursday this week, and it was softer for the steel component last month. And going to Golden Week, it does feel like demand could be a bit softer as well, given there's been some restocking just recently. So yeah, look, I think the red flags are still there. They're continuing to build, and we're still eyeing a price lower from here in the balance of the year for quarter 4, but also lower into next year as well.
Where do you see iron ore prices from a longer term perspective? As a marginal producer, where do you think that the prices will trough longer term?
I'm going to give you a number of $55. It seems absurdly low, doesn't it, compared to today's price of $115, but that's where they'll go. And interestingly, with all the issues with supply of late and saber rattling by Australia and dam issues in Brazil and other supply issues in Brazil, the Chinese must really be looking for an alternative secure supply. So this notion of African supply that's been talked about in Guinea, an operation called, or a project called Simandou, I think that just hastens the build of that project, and that could be the balancing item in the markets going forward, which will get us back to that lower balanced number. And ultimately, in a balanced market, it's not about incentive prices to get people to provide more, it's about what price to maintain an orderly market, and that's somewhere in that 55. If I was being generous, maybe 60, 65, but it's certainly a lot lower than where we are today. So we're looking at about a halving of price from where we are today at some stage over the next 1, 2, 3, 5 years. So we're on a glide path, which is why we look at it and say fade the iron ore rally and start taking some profits and putting those profits elsewhere.
Yes, that Simandou project in Guinea is fascinating. Basically, talking about scooping iron ore straight off the hilltops. That's how easily accessible it is. Obviously, getting it to port is another story, but definitely something to go keep an eye on. Another thing to go and keep an eye on has been the gold price, extremely volatile over the past month or so. When it saw a trade north of 2,000 an ounce, should I say, US. Briefly, it's now back around about 1860 an ounce. What do you see where it happens to the gold price? When we've spoken in the past, you talked about prices moving high. Is this a healthy pullback that should be bought?
It is. It's a pullback on a journey which we're going to be on, which I've mentioned before, is multiple quarters and probably multiple years. And that's very rare that you get a story which could play out that far. And why is it playing out that far? Because the drivers of gold price are central bank expansion, which is printing money, which we're seeing globally by central banks. That's driving the overall long-term price view. And that's substantially higher, particularly in the last 6 months. But more importantly, interest rates, but real interest rates, low real interest rates, and in particular negative real low interest rates at the moment. So, and the trend of that is likely to be negative for quite some time, potentially to 2022, 2023, and that's per the commentary from the Federal Reserve in the US just over the last week. And on that basis, and seeing inflationary expectations start to build over that time, real negative rates will increase, and we're now around about 1% negative. That could build to well above 2%, and extrapolating correlation charts of gold price to real rates, which suggest a price for gold back somewhere closer to $2,500. So going through that peak you mentioned before and taking it higher. And the third part of this is ETF flow, or the trading and the options around this, and that's the squeezy money that comes in at the highs and also in the lows, which we're seeing at the moment. So pushes things lower, pushes things higher, and when gold price does peak at some stage over the next 1, 2, 3 years, that squeeze will take it well above what the number I've just talked about. So $2,500, see that as a target, with a frothy movement above that at some point, driven by ETF flows and people wanting to buy physical gold, etc. So gold price story definitely not over. opportunity to buy, absolutely. Do you have to buy it today? I think you're going to sit here and watch. It's going to be soft for a little while till we see rates and US elections start to get some semblance of order, but definitely going higher and definitely a medium-term story, which is very rare in these markets.
Certainly some pretty strong tailwinds for margins, you would imagine. Peter, is there any particular name in the sector that you like over others?
It's an interesting answer because everything looks good. If in a gold price environment like that, everything's going up. So short answer, you can buy anything and they should all go higher, all things being equal. But what do you buy? You try and look in on my matrix charts of value versus positioning, where the stocks look cheaper. And right now, the ones that look cheapest are Regis, Newcrest, Resolute, St Barbara, and some of those have had specific issues, which is why they've been held back relative to their peers. But looking at their relative value, they're the ones I'd be looking at, trying to understand what issues they have they been overcome, as in Resolute overnight with articulating a new labour agreement in their operations in West Africa. But the ones that still look good but a little bit more expensive, Saracen, Evolution, Northern Star, nothing wrong at all with those companies, just looking a little bit more generously priced than some of those other names. So I'd buy a basket. I'd buy some of the bigger names, I'd buy some of the emerging names like a Ramelius, and maybe drill down to some exploration names as well. But there's an opportunity in this space to buy almost anything and they'll go up. But again, top picks would be, there's the ones that just lagged a little bit in the short term, which would be Newcrest, Regis, Resolute, St Barbara would be the ones that would stand out to me at the moment.
You can see everyone at home jotting down those recommendations. Peter, you've been very generous with your time as always. I'm going to ask you one more question. Whitehaven Coal, it's quite a divisive company in many, many different ways, including in the investment community. What we've seen recently is that every time we see one step positive up to the upside, it seems to be hit back down and hit even harder. Where do you stand when it comes to Whitehaven Coal longer term?
We are at an opportunity right now at the bottom of the cycle, in the coal price cycle, and depending on your views ethically about do you want to buy coal or not, and if you choose not to, disregard my comments from here, but if you look at this as a value opportunity, it's one of the cheapest stocks in the market that I cover in terms of its pricing and its share price performance. So it stands out for that reason. Then doing a bit of digging into its commodity mix in markets for thermal coal, for energy generation, also steel making coal for steel making in Asia, those prices have started to turn literally in the last 1 or 2 weeks. This is after about a 2-year downdraft. And those stages of turning are early, but they look fairly high conviction, with India coming back into buy, some potential from China as well. So commodity equities follow commodity prices, and it looks like we're at the bottom end of that 2-year downtrend. We had a great 2-year uptrend from 2015 through mid-2017 to 18. We've been on a long downdraft, but as you said, it's been taking one step forward and one step back as they've moved. But I think we're at the right side of this curve. So valuation-wise, Whitehaven and energy as a basket looks to be some of the cheapest parts of the market, both as a sector, be it oil, gas, coal, uranium, and Whitehaven stands out as, in my basket, one of the cheapest out there as well. So definitely on the buy side of the ledger at this time.
Certainly a few fans out there today currently sitting up 4.2% or $1.05 per share. Peter O'Connor from Shaw & Partners, fantastic to get your views. Enjoy the rest of your day.
Thank you very much.